If you watch to the end of this video, you're going to learn the real secret as to why real estate is the #1 wealth builder for families. You're going to see and learn something that you can internalize for a lifetime. It's something that nobody likes to talk about. It is a secret in real estate. There are so many tax benefits in real estate, yet nobody talks about the biggest one. That's what we're going to talk about right here. See, I got my tax glasses on today because so many people get this wrong. So many families fail at understanding this crucial part about real estate taxation. And it is so important. It's going to save you so much money because I'm going to show you a way to never pay taxes. Look, you can avoid or defer paying capital gains taxes with things like exchanges or other creative ways to basically delay when you pay taxes. Everybody seems to think that eventually you have to pay. And I'm going to tell you in this video that you don't. This, of course, is completely legal, and it is just a secret that not a lot of people know about, and it's time to share it. Note, it's really important that you watch the example that I give you because it's going to set up the impact of why this is so amazing in terms of how you will never pay taxes. It's not the most fun topic. And if you're just starting out and you're like, well, Kevin, why do I care? Why do I care about this? I don't own anything yet. Because you need to internalize this now to prevent people around you from making the mistake, and so that you know for the long run, when you invest in real estate, you can actually never pay taxes on your capital gains. Here we go. So I was inspired to make this video because totally ironically, Graham Stephan made a tax video that he released on Monday. And this weekend, I filmed a video that didn't go well, but it was going to talk about this same reveal that I was going to talk about in this video. And it was very interesting that he happened to release a video on taxation the very day I realized that my video was a flop. Here are some clips from what I was going for. Let's get started, because I know you're all aspiring real estate investors, or needless to say, it just didn't work out. Graham touched on some amazing points, including the capital gains exclusion, some tax write-offs that you get from things like interest, depreciation, and the opportunity to defer capital gains taxes by doing 1031 exchanges. This was an excellent tax overview video, and I encourage anybody to go look at it. But I'm going to share something that has to do with not the tax benefits today, but the long-run tax benefits that will help you make the realization that this is where you want to invest your money. So let's set this up. I always talk about buy. So I always talk about buying, but at some point there comes a time to sell. And I'm going to set up an example here where you see you're actually at some point in real estate forced into selling thanks to tax laws. So let's get into that. And then the big reveal. There are 2 times it really makes sense to sell. 1, when a better opportunity comes up to make a greater return on your invested money or your equity in a property, and you can catapult that into something else that is going to make you more money. Or 2, the property is fully depreciated. Let's talk about depreciation. You really want to internalize this example because it's really going to hit the message home and the trick. So if you're going to watch 100% of any of my videos, let it be this one because it's so important. Folks, depreciation is a paper term. It means that you are telling the government, I own an asset that is declining in value and in the future will be worth 0. As a result, the government lets you take write-offs or say that you're losing money on a set schedule, a depreciation schedule, basically just a time frame. So here's a quick primer on why you want depreciation. Depreciation is a tax benefit. Much like other tax benefits help you shelter income. If you make $10,000 in rental income, you usually have to pay anywhere between 20 to 50% on taxes on that money, depending on what state you live in, because rental property income is usually the last income you make that's above and beyond your job. It's usually taxed at the highest rate of your marginal dollar. That's complicated. Don't worry about that. But for me, when I do my taxes, I look at any rental property income I get as being taxed at least 40%. So for me, if I have $10,000 in rental property income, I pay $4,000 in taxes on that rental income. However, if I have $10,000 in rental property income and I have $10,000 in a tax write-off, I don't pay any taxes. That's great. That's not the big secret. Don't worry about this. This is just a primer. We're just getting started here. Now, how does depreciation work into this? Let's say I buy an asset for my factory. Let's say I have an olive oil mill and I have some kind of press, a machine that presses the olives and makes olive oil come out. I don't know how to make olive oil. Let's just say that. The government might tell us that this machine has a useful life of 7 years. So if I paid $70,000 for this machine, I could, in a straight line depreciation method, write off $10,000 per year. $10,000 per year, and say that the asset, the machine, is worth zero at the end of those 7 years. There are other forms of depreciation, like accelerated methods, where you write off, say, $14,000 year one, and then say $3,500 the last year to kind of give you more of a tax benefit early on. And there are plenty of other depreciation schedules, but we're just going to consider straight line because that's what matters in real estate. Straight line just means an equal amount every single year. Now I have a $10,000 tax benefit from that machine every single year. So if I make $10,000 selling olive oil and I have this $10,000 write-off, I'm not paying taxes because that machine is giving me depreciation. Love it. Now let's say after 7 years, the machine's old, I need a new one, and I sell it for $1,000. But I told the government it was worth zero. Now, the government does what's known as something called depreciation recapture. This is really important to understand. When you sell something for more than what you told the government it was worth, they make you pay taxes on the difference. This is why generally, even though you can depreciate your properties and you can defer paying taxes on your gains in real estate by doing exchanges and by depreciating, eventually the government wants their money, unless you do what I'm about to tell you in this video. Crucial. But get this part first. Now you have an understanding of tax benefits, depreciation, and the straight line method. Let's look at real estate now. In real estate, you can depreciate improvements. You cannot depreciate land. So let's say you bought a $375,000 property, and we're going to say the land is worth $100,000. Say it's 30% or whatever. And we have an improvement that we can write off or depreciate over a depreciation schedule, then we get to claim a tax benefit. So in real estate, you have a $275,000 improvement, $100,000 of land, $275,000 of improvements. You get to depreciate or write off that $275,000 over, if it's a residential real estate, 27 and a half years. If it's a commercial building, you don't get as good of a benefit. You have to write off the property over 39 years. Remember, the quicker you can depreciate something, the more of a tax benefit you get now. And you want more tax benefits today. That's why in that machine example, people like accelerated depreciation because I get more tax benefits now after I just spent money on a new asset, rather than tax benefits later. Money is worth more today than it is tomorrow. Very bottom line principle. So in this example, you get to take $275,000, that's $375 property value, minus the cost of land, divided by 27 and a half. Now you get a tax benefit of $10,000 a year that you can help to offset your rental income. It's a huge benefit. But much like the machine, after 27 and a half years, that property is technically worth zero plus the land. Remember, you can't depreciate the land, so that $275,000 portion might be worth zero, but you still have value in the land. Now, you don't get a tax benefit anymore. You're done. You're fully depreciated, no more write-off. That sucks. Now it's time to buy something bigger and better. This is where you're actually forced into a sale because you want that tax benefit. So now you have to sell the property and buy something bigger and better so you can have more depreciation. Now we all know that after 27 and a half years, your $375,000 property probably isn't worth $375,000 anymore. Let's say it's worth $1 million. Now you go to sell, the government goes, wait a minute. You just told us it was worth $100,000, just the value of the land, and you just sold it for $1 million. Whoa! Hey! We want taxes on $900,000. So if we go with a long-term capital gains rate of 25%, the government wants $225,000 at the time of your sale. But wait. You're going to do a 1031 tax deferred exchange, which Graham did a great example of what an exchange is. But basically, you're saying, wait, government, I'll pay you that $225 later, but I want to use all of this money and buy some more rental property, and I'm going to grow some more assets for you, and basically make it so you can collect a lot more taxes from me later, because, well, I'm a really good real estate investor, and I'm going to make you some more money. And that's fine. The government encourages 1031 exchanges, so you can go ahead and not pay any of those taxes now, and instead go buy another property. But here's where the crucial mistake comes in. Big mistake people make is when they get tired of rental property, they sell their rental property. Generally when they're 70, 80, 90 years old, they start selling off their rental property, they stop exchanging, and they bite the bullet. They pay taxes. This is where people say you just can't escape the government, and even though you can defer paying taxes, you can't get away from paying taxes. But you can, and this is the crucial mistake, is these people sold and paid the taxes. They shouldn't do that. So let me give you the legal method to never pay taxes. This is what I'm calling the massive secret. The reason I say it's such a secret is because you could gain decades and decades of net worth, and the government is expecting their taxes at some point when you go to sell. And if you do this one thing, you won't pay them a dime, and neither will your family. You ready for this, folks? This is intense. You die. That's right. You die. When you die and you own real estate, you get what's called a stepped up basis. Here's what that means. Let's say you owned 10 of these $375,000 properties. And they're all worth $1 million now. So that means you have $10 million of real estate. And each of those had $900,000 of gains. Remember, we just did that. That meant for each property, you would owe the government $225,000 in long-term capital gains taxes. That means over $2.2 million would go to the government in capital gains taxes if you just started liquidating these assets before you died. Instead, when you die and you still hold the properties, so that's where the mistake is, don't sell before you die, you get a stepped up tax basis to the market value of the property at the time of your death. So you never paid taxes because you never sold them other than via a 1031 exchange, and your family never paid taxes, which is why your family can reap massive real estate wealth from the investment decisions you make today, which talk about a legacy is awesome. I mean, it blows my mind that this exists. But now you get this stepped up tax basis. You technically owed $2.2 million because you bought 10 properties for $375,000 each, so $3.75 million. Now they're worth $10 million, and you owe over $2.2 million in taxes because of all these gains and all the depreciation write-offs you had and all the deferments. Then you die, the property values go whoosh, $10 million bucks. No capital gains here. I didn't make any gains because I just died. That's it. That simple. Now, there's a bonus reveal to this secret. I'll talk about that in 1 second. But I want you to internalize this. This is a massive, massive secret to real estate wealth that if you internalize, you will never, ever pay taxes. And nobody related to you will ever have to pay taxes on the massive amounts of money you can make in real estate by riding the long-term real estate investing game. And it's eerily quite simple. So here's the bonus tip. In community property states, and obviously all of this information you should check with a CPA and attorney to verify. And remember, dying is not a tax strategy. It just happens to be a dramatic benefit when it comes to taxation for your family. And note too that the estate tax now only kicks in at a net worth of like $22.1 million for couples. It's nuts. But there's another win here, another secret bit of information to know. In community property states like California, if you own a property and you take title with a spouse as community property with right of survivorship, this is, if the Realtor Association hears me talking about this, I'm going to get in so much trouble because you really need to talk to a CPA and attorney about this stuff. But my understanding, and I could be wrong about all of this, is that if you take title as community property with right of survivorship and one of the spouses dies, the other person gets a double stepped up basis. So here's how it usually works. Usually, when two people are on title to a property, and say they bought a property for $1 million, and now it's worth $2 million, one person dies, the property gets stepped up half. So that means the tax basis goes from $1 million to $1.5 million. Well, if you took title as community property with right of survivorship, your tax basis goes from $1 million to $2 million for the surviving partner. So that means the surviving person could, the day after the other spouse's death, sell the property and pay zero capital gains as well. And then, here children, have money, tax-free. Obviously, there are gift limits, and there's so many other complicating factors when it comes to taxes. But internalize this, folks. This is crazy. This is a legal way to never, ever, ever pay taxes in real estate. Take advantage of it. Thank you, Graham Stephan, for the amazing outline you had. Great information out there, and I'm glad I finally got this whole taxation thing off my chest.